If you have spent any time building a high-yield dividend portfolio, you know that the hardest question is not finding income. There are hundreds of ETFs, REITs, BDCs, MLPs, and preferred stock funds promising meaningful yields. The hard question, the one that separates disciplined, long-term income investors from people who are constantly chasing the next shiny thing, is which of those investments do you trust enough to put the most amount of your money into? Which holdings do you commit to as the true foundation of your income strategy? The ones you are not constantly rotating in and out of, not second-guessing every time the market gets volatile, and not replacing the moment something with a higher headline yield comes along. That is what we are talking about today on Dividend Desk. I am going to walk you through what I consider to be the cornerstone investments of a high-yield dividend portfolio, the holdings that represent the largest concentrations of capital, the most conviction, and the clearest long-term income rationale across several key categories. We are covering index-based covered call ETFs, REITs, energy, business development companies, preferred stocks, and international income. This is not a comprehensive list of every position in a 30-holding portfolio. It is a look at the ones that carry the most weight, financially and philosophically, and why they earn that position. And I want to be upfront about something right at the start. Opinions in investing are never permanent. The holdings I am going to walk you through represent my best thinking at this moment in time. If a fundamentally better product comes to market, if a company's track record deteriorates, or if the data starts pointing clearly in another direction, those opinions will evolve. That is not inconsistency. That is disciplined investing. Rigid attachment to specific holdings regardless of changing fundamentals is one of the most dangerous habits an income investor can develop. So everything I share today comes with that understanding clearly attached. Let's get into it. Before we dive in, if you are not yet subscribed to Dividend Desk, hit that subscribe button right now. We cover income investing, dividend ETFs, REITs, BDCs, and portfolio strategy every single week. Hit like if this video adds value. Now let's go. Disclaimer. Nothing in this video is financial, investment, or tax advice. I am not a financial advisor. Everything here is purely for educational and informational purposes. Please always do your own research and consult a qualified professional before making any investment decisions. Every investment discussed carries varying degrees of risk and potential tax consequences. Understand those before committing any capital. When it comes to the covered call and options-based portion of a high-yield dividend portfolio, there is now a genuinely wide landscape of choices. The category has exploded in the last few years. You have Goldman Sachs with their premium income funds. You have the older generation of Global X funds, like XYLD and QYLD, that many income investors grew up with. You have TAP Alpha's TSPY and TDAC. You have JP Morgan's JEPI and JAPQ. And while those two are not technically pure index funds since they also incorporate equity-linked notes, they behave closely enough to earn consideration in the same category conversation, and you have newer entrants from Defiance, YieldMax, Roundhill, and others continuing to push into this space. With all of those options available, the question becomes, how do you decide where to put the largest concentration of your capital within this category? The answer starts with philosophy. When I think about what I want from the most important covered call holdings in a portfolio, the ones I genuinely want to hold for years without rotating out, there are a few non-negotiable criteria. First, I want exposure to a major broad market index, not a single sector, a single stock, or a niche theme. Index-based covered call funds are the most diversified option available in this space. If they are declining, it is because the broad market is declining, not because one company had a bad quarter, one sector fell out of favor, or one commodity cycle turned. Broad market index exposure is inherently more durable than sector-specific or single-stock exposure, and durability matters enormously when you are making core portfolio decisions. Second, I want the best available balance between yield and NAV preservation, and this is where the current landscape makes a very clear distinction between the options available. On one end of the spectrum, you have funds that prioritize share price growth above income. The Goldman Sachs funds, for example, which have done an excellent job of limiting NAV erosion in 2026, but yield only in the 8 to 8.5% range. For income investors who are specifically building a portfolio to generate meaningful monthly cash flow, that yield sacrifice is significant. A portfolio generating 8.5% when alternatives in the same broad category can offer 12 to 15% is leaving a lot of income on the table. On the other end of the spectrum, you have funds that chase maximum yield at the expense of NAV stability. Funds in this category, and there are many, including some of the more aggressively constructed Yield Max and Defiance products, pay eye-catching distribution rates, but have experienced meaningful NAV erosion over time. As we have covered extensively on this channel, NAV erosion is the silent killer of income portfolios. A fund that pays you 20% annually but loses 15% of its share price per year is not generating sustainable income. It is slowly liquidating your own capital and handing it back to you as a distribution. The funds that currently hit the best balance between these two extremes in my view are SPYI and QQQI from NEOS. SPYI is the NEOS S&P 500 High Income ETF, currently yielding over 12%. QQQI is the NEOS NASDAQ 100 High Income ETF, targeting a 12 to 15% annual distribution range. Both use Section 1256 index options, which we covered in detail in a previous Dividend Desk video, giving them meaningful after-tax advantages over funds that use equity-linked notes or standard ETF options. Both use a dynamic options management approach that adjusts how much of the portfolio is overwritten and how far out of the money the options are positioned, based on market conditions. And both have demonstrated the best combination of NAV resilience and high income generation of any funds I have found in this category. I want to be transparent about the fact that this opinion has evolved over time. Before NEOS's funds established the track record they now have, Global X funds, specifically XYLD and QYLD, were the go-to options for income investors in this space. I held them, a lot of long-term income investors did. But when NEOS came to market, with a demonstrably better approach to NAV protection while maintaining comparable or higher yields, the rational move was to make the switch, and that same openness to switching applies going forward. Global X recently launched two new funds, EDGX and EDGQ, that mirror NEOS's yield and upside profile but pay weekly distributions. We covered those funds recently on Dividend Desk. The early results are encouraging. If they continue to demonstrate genuine NAV resilience over a longer track record, the case for holding them alongside or instead of the monthly NEOS funds gets stronger. I am watching them closely. Every serious income portfolio needs real estate exposure. REITs, or real estate investment trusts, are legally required to distribute at least 90% of their taxable income to shareholders, which makes them structurally high-yield vehicles. They also provide portfolio diversification because real estate tends to have different performance characteristics than equities and fixed income over full market cycles. But not all REITs are created equal, and in a category with hundreds of options, the selection of which REIT or REITs to build around as a cornerstone position matters enormously. The criteria I prioritize for a core REIT holding are different from what I prioritize for my covered call ETFs. With covered call funds, I am primarily optimizing for income generation with acceptable NAV behavior. With a REIT, I am looking for something different, long-term, dividend, growth, and dependability. Because a retirement income portfolio that does not grow its income is a portfolio whose purchasing power is slowly being eroded by inflation. A REIT that has been paying and consistently growing its dividend for decades, through recessions, through interest rate cycles, through global pandemics and geopolitical shocks, is a fundamentally different proposition from a high-yield product that is simply distributing whatever it can generate month to month. On that basis, one REIT stands completely apart from the rest of the field. Realty Income, ticker O. Realty Income is a monthly paying REIT with a track record that is genuinely difficult to match anywhere in the income investing universe. They've raised their dividend consistently for decades. They hold a diversified portfolio of commercial real estate properties under long-term net lease agreements, meaning the tenants pay most of the operating costs, and that, in turn, provides the company with predictable, stable cash flows across economic cycles. the yield isn't the highest available in the REIT space. But honestly, the combination of yield, dividend growth rate, diversification, and track record creates a risk-adjusted income profile that I have never found a compelling reason to replace. The compounding effect of consistently reinvesting realty income dividends over time produces the kind of results that really illustrate why dividend growth matters just as much as current yield. When you're reinvesting those monthly distributions at a price that fluctuates with the market, and the dividend itself is growing over time, the share accumulation process compounds in a way that can meaningfully accelerate your income trajectory. Owning 500 or more shares of a company like Realty Income and continuing to add through dividend reinvestment is, in my opinion, one of the most powerful slow-burn wealth-building strategies available to income investors. Now, REITs are cyclical to a degree. They're sensitive to interest rate movements since real estate is a capital-intensive business that relies on financing. When rates rise sharply, as they did in 2022 and 2023, REIT share prices tend to decline as borrowing costs increase and yield comparisons with fixed income become less favorable. But for a long-term investor who's reinvesting dividends through those periods, rate-driven price weakness is actually an opportunity. You're buying more shares at lower prices with a growing dividend in a company with decades of proven track record. That, right there, is the mentality that makes Realty Income work as a cornerstone position rather than just a trade. Energy is a category that, honestly, every income investor should have at least some exposure to, and the reasons go beyond just the yield. Energy infrastructure is genuinely non-discretionary in the modern economy. Pipelines, storage facilities, and transportation networks for oil and natural gas are essential no matter where we are in the economic cycle. And certain energy-focused investments, particularly master limited partnerships or MLPs, offer some of the most compelling yield plus growth combinations available in the income investing landscape. My current favorite energy holding is an MLP. MLPs are partnerships that own and operate energy infrastructure assets, and they're structured in a way that passes most of their income directly to unit holders without the corporate layer of taxation that applies to regular dividend-paying stocks. This pass-through structure is what enables the higher yields MLPs typically offer. The trade-off is an additional tax form, a K-1, that investors must file with their annual tax return, which honestly adds a bit of complexity and cost to tax preparation. For a long time, a pipeline giant like Enbridge was the preferred energy holding, a well-established, diversified pipeline company with a long track record of dividend growth and a yield that made it attractive for income portfolios. And Enbridge remains a solid holding that I've not exited. But the reality of a significant share price run-up over time is that the yield on your original cost basis may look great, but the current yield available to new buyers is less attractive than it once was. And when both the current yield and the dividend growth rate of an MLP have been running ahead of a legacy position for a meaningful period, the rational response is to redirect new capital toward the stronger current opportunity, rather than continuing to build the lower-yielding position. The best MLPs in the current environment are generating returns that are almost never associated with investments yielding consistently above 7%. When you combine a distribution yield of that magnitude with meaningful distribution growth, not a one-time special payment, but year-over-year growth in the regular quarterly distribution, you have a compounding income machine that is genuinely rare. The geopolitical environment has also provided tailwinds for energy in 2026, with Middle East tensions driving energy prices higher and benefiting energy infrastructure stocks broadly. The K1 is a real cost, and investors should not underestimate it. If you are using a tax professional to file your returns, an MLP holding adds to your preparation cost every year. For investors in straightforward tax situations who prefer to file simply, that burden may outweigh the income advantage. But for investors who are already working with tax professionals and are building serious income portfolios, the additional cost of a K1 is modest relative to the income advantage a high-quality MLP can provide. Business development companies are, honestly, one of the most misunderstood and underutilized categories in income investing. BDCs lend money to, and sometimes even take equity stakes in, small and mid-sized businesses, companies that are just too small or maybe a bit too risky for traditional bank financing, but that still have real operating businesses and some solid growth potential. Like REITs, BDCs are required to distribute the vast majority of their taxable income. And that's what enables their characteristically high yields. And, just like with REITs, the quality variance within the BDC category is enormous. There are some excellent BDCs, and, honestly, some genuinely dangerous ones. So, knowing the difference really means digging into the fundamentals instead of just chasing the highest yield. Two BDCs stand out as the cornerstones of a thoughtful BDC allocation: Ares Capital and Main Street Capital. Ares Capital, ticker ARCC, is the largest publicly traded BDC by assets under management, and it has been the dominant name in this category for most of the past decade. For anyone who has followed income investing for any length of time, Ares Capital is likely the first BDC they encountered. It offers one of the most consistent distribution track records in the sector, with a management team that has navigated multiple interest rate cycles and credit environments while maintaining the dividend. The current interest rate environment has generally been favorable for BDCs since they lend at floating rates, meaning their income rises as rates rise. Ares has held up particularly well even as rates have begun to moderate, maintaining its distribution coverage and demonstrating the credit discipline that separates the best externally managed BDCs from the rest of the field. I want to address the externally managed versus internally managed distinction here because it matters for how you evaluate a BDC. Ares Capital is externally managed, meaning the company that manages the portfolio is a separate entity that charges management fees based on assets under management. The criticism of external management is valid. Management fees incentivize growing the asset base, rather than necessarily growing the stock price or the distribution. External managers are paid more when the portfolio is larger, regardless of whether that growth benefits shareholders. Main Street Capital, ticker MAIN, is internally managed, which means the management team is employed directly by the company and compensated based on the company's performance. This alignment of incentives is genuinely superior for shareholders. Management benefits when the stock does well and when the distribution grows, not simply when assets under management increase. Main Street has consistently demonstrated the quality of that alignment. They have been reporting NAV growth even in the current environment where many BDCs have seen their book values under pressure. They continue to pay one of the best covered dividends in the BDC sector. And while their special dividends, which they have historically paid, in addition to their regular monthly distribution, are likely to moderate somewhat this year, their core dividend remains exceptionally well covered. The honest assessment is that both belong in a serious BDC allocation, with Main Street's internal management structure giving it a structural edge for long-term holding, and Ares Capital's track record and scale giving it durability and consistency that makes it hard to replace as the anchor externally managed BDC position. Preferred stocks occupy an interesting position in the income investor's toolkit. They sit above common stocks in the capital structure, meaning in the event of a bankruptcy, preferred stockholders are paid before common stockholders, and they are typically required to receive their full dividend before any dividends can be paid to common shareholders. This structural priority makes preferred stocks inherently safer than common equity in a distressed scenario, which is why they are often described as a hybrid between stocks and bonds. For preferred stock exposure, rather than holding individual preferred issues, which honestly requires significant research into individual company creditworthiness, and preferred share structures, a diversified ETF is the cleaner approach. The fund worth discussing here is PFFA, the Virtus InfraCap US Preferred Stock ETF. PFFA stands out from other preferred stock ETFs for one primary reason: it offers the highest yield in the preferred ETF category. It achieves that yield through two mechanisms. First, it focuses on higher-yielding preferred issues, which are typically issued by companies with somewhat less pristine credit profiles than the largest investment-grade corporations. Second, and importantly, it uses a meaningful amount of leverage, borrowed capital, deployed to amplify the income it generates from its preferred stock holdings. Those two features, higher risk underlying holdings and leverage, are what make PFFA a different animal from safer preferred ETFs, and I want to be very direct about this. Do not make the mistake of thinking that because PFFA holds preferred stocks, it is a conservative, low-risk investment. It is not. The leverage component creates real downside risk in stressed markets. During COVID, PFFA was forced to cut its dividend, The leverage amplified the stress in the portfolio in a way that required a distribution reduction to protect the fund's structure. However, PFFA has been paying and growing its distribution for more than 5 years since that cut. It has survived Liberation Day, market volatility. It has survived the recent geopolitical shocks, and for investors who understand what they are buying, a leveraged preferred stock fund with above-average yield and above-average risk, it plays a specific and useful role in a diversified income portfolio as long as the allocation is sized appropriately relative to lower-risk core holdings. International exposure is one of the most underweighted areas in most income investors' portfolios, and it is an understandable gap. The US market has dominated global returns for most of the past decade and a half, and the dividend yields available from most international ETFs are underwhelming. A standard international index ETF typically yields somewhere between 1 and 3%, which is hardly compelling for a portfolio oriented around income generation. But 2026 has been a significant reminder that US equity dominance is not permanent. International markets have outperformed the US meaningfully this year, and income investors who had no international exposure missed that entirely. The fund that fills the international income gap better than anything else currently available in the ETF space is IDVO, the Amplify CWP International Enhanced Dividend Income ETF. IDVO assembles a concentrated portfolio of 30 to 50 international dividend-paying stocks, selected based on multiple quality metrics, and layers a tactical covered call strategy on top to enhance the income generated beyond what the dividends alone would provide. The result is a fund that typically yields between 6 and 7%, dramatically more than any standard international ETF, while also paying monthly distributions and demonstrating genuine NAV appreciation over time. What makes IDVO particularly compelling is the combination of yield and growth it has delivered since launch. The monthly distribution has nearly doubled over approximately 2.5 years, which means investors who have been holding since inception are not just collecting income, they are watching that income grow meaningfully over time. And the share price has appreciated alongside it, which is a very unusual combination to find in the international income space. To be clear about where IDVO sits in a portfolio framework, it is an international fund first, and a covered call fund second. The covered call overlay is a tool for income enhancement, but the core of what makes IDVO valuable is its exposure to high-quality international dividend-paying businesses in a world where that exposure has been rewarding in 2026. For income investors who have little or no international exposure in their current portfolios, IDVO is one of the clearest and most compelling options available. So there is a complete look at the cornerstone holdings that form the foundation of a thoughtful, high-yield dividend portfolio across 6 key categories: index-based covered call, ETFs, REITs, energy, BDCs, preferred stocks, and international income. A few things worth underscoring as we close. First, you will notice that with the exception of the covered call funds, these are not the highest-yielding investments that exist in each category. They are the investments that combine a meaningful yield with the durability, growth potential, and track record that justify building large positions around them. There is a difference between chasing the highest yield in any given category and identifying the best risk-adjusted income generator in that category. The cornerstone holdings are always the latter. Second, this is not a static list. The income ETF landscape specifically is evolving faster than almost any other area of investing right now. When new funds are launching regularly, track records are being established and tested, and when a genuinely better option emerges, one with superior NAV protection, better tax efficiency, stronger income generation, or more compelling total return characteristics, the right response is to evaluate it seriously and make changes where the evidence supports doing so. At Dividend Desk, our commitment is to track that evolution closely and bring you the analysis that helps you make those decisions with clarity rather than noise. If this breakdown of cornerstone portfolio positions was helpful, please hit the like button and subscribe to Dividend Desk so you never miss a video. Join the Dividend Desk community. The link is in the description below, where we go deeper on all of these positions and discuss portfolio strategy in real time. This is Dividend Desk. We will see you in the next one. This video is for educational and informational purposes only. It does not constitute financial, investment, or tax advice. Dividend Desk is not a financial advisor. Always do your own research and consult a qualified professional before making any investment decisions.